Hi everybody, and welcome back to video number 2 in chapter 2. And here when we left off, we were looking at assigning manufacturing costs to jobs. And of course, when you're estimating overhead through the predetermined overhead rate, you're going to sometimes have inaccurately assigned manufacturing costs. And that adversely influences planning and decisions made by managers because we don't know the price, the cost of those jobs. So number one here, job order costing systems can accurately trace direct materials and direct labor costs to jobs. That is done pretty routinely through our computer systems, to be honest. But job order costing systems often fail to accurately allocate manufacturing overhead costs used during the production process to their respective jobs. I can remember working at Xerox as an internal auditor in one of my first positions where they were so inaccurately assigned that Xerox didn't know what it cost to make their product. And they were losing money on every single unit that they manufactured. So the more they sold, the more they lost. A very bad situation. Naturally, we got that straightened away as quickly as we could. But sometimes failing to accurately allocate those costs during the production process can have pretty dire consequences. So, if we choose an allocation base, we often in a job order costing system, we often use an allocation base that do not reflect how jobs actually use overhead resources. The allocation base in a predetermined overhead rate must drive the overhead cost to improve job cost accuracy. A cost driver is a factor that causes overhead costs. Many companies, all the ones that I've worked for, use a single predetermined overhead rate called a plant-wide overhead rate to allocate all manufacturing overhead costs to jobs based on their usage of direct labor hours. Number one, it is often an incorrect assumption that direct labor hours is the company's only manufacturing overhead cost driver. And that is true. Number two, if more than one overhead cost driver can be identified, job cost accuracy can be improved by using multiple predetermined overhead rates. Okay, so let's compute the total cost and unit product cost using multiple predetermined overhead rates. Here, the Dixon company has two production departments, milling and assembly. The company uses a job order costing system and computes a predetermined overhead rate in each production department. The predetermined overhead rate in milling is based on machine hours, quite logically, and the assembly department is based on direct labor hours, again, quite logically. The company uses cost plus pricing and a markup percentage of 75% of total manufacturing cost to establish selling price for all of its jobs. I could take issue with that. However, that's what the problem says here, so we'll go with it. At the beginning of the year, the company made the following estimates. Here's our machine hours in the milling department. Here's our direct labor hours in the milling department. Total fixed manufacturing overhead, variable manufacturing overhead per machine hour. Same thing here with the department assembly, the assembly department for 3,000 machine hours, 80,000 direct labor hours, and 500,000 fixed overhead, and at $3.75 per direct labor hour for variable manufacturing overhead. So you can see there's quite a difference here between machine hours used in milling and the ones used in assembly. And conversely, much more direct labor hours used in assembly than in milling. Okay. So during the current month, they started and completed job 407. It wants to use its predetermined departmental overhead cost and rate for milling and assembly departments. So if we come back to our schedule here for the milling department, we had $390,000 of fixed overhead, and our variable overhead was $2 per machine hour, and we had 60,000 machine hours for a total overhead of $510,000. Assembly department, we started with fixed overhead of $500,000. Our variable overhead based on direct labor hours was another addition, totaling $800,000. All right, those are our estimates, right? Those are estimates. So we now have our total overhead for each department, milling and assembly. Now, we use those amount to determine on the previous slide to calculate the predetermined overhead rate of each department. So we take that 510,000 and divide it by the 60,000 machine hours. So that means we're going to apply overhead of $8.50 per machine hour used in the milling department to the jobs that they create. Same thing in assembly, except we're going to use direct labor hours here into our total overhead to get $10 per direct labor hour. Now, we have a job, and here's that job, job 407. And we had these machine hours, these direct labor hours, these direct materials, these direct labor costs for each of those departments. So for overhead, we're going to take the 90, in milling, we're going to take the 90 machine hours times the $8.50 per machine hour to get $765 for this job. In the assembly, we're going to have 20 direct labor hours, and we'll multiply that times the $10 we calculated per direct labor hour to get to $200. Again, remember, these are estimates. Okay, so now we can calculate our product costs. Here's our direct materials in milling, our direct labor in milling, and our applied overhead in milling. Same thing with assembly, direct materials, direct labor, and applied overhead. We add the two of those beauties together, and we get a total job cost of $2,485 for job 407. Okay, so now if we use that cost on job 407 for our selling price, we're going to take that total cost of job 407 and multiply that times 75%. I get $1,863.75, and my selling price, therefore, is going to be $4,348.75. It's important to emphasize that using this departmental approach to overhead application results in a different selling price for 407 than would have been derived using a plant-wide overhead rate based on either direct labor hours or machine hours. The appeal of using the predetermined departmental overhead rates is that they presumably provide more accurate accounting of the costs caused by the jobs, which in turn should enhance management's planning and decision making. That, of course, assumes that it's worth the trouble of doing that extra calculation, that increased accuracy. Is it worth the extra trouble? And of course, in this example, it clearly was. All right, when a company creates overhead rates based on activities that it performs, then it's employing an approach called activity-based costing, often abbreviated ABC. If you're familiar with inventory, for example, ABC is sometimes used to categorize inventory into the expensive, medium expensive, and cheap raw materials that you have, all so-called ABC. But this is activity-based costing, and it's an alternative approach to developing multiple predetermined overhead rates. This is going to be the most accurate. And of course, the most lengthy to calculate. We use activity-based costing systems to more accurately measure the demands that jobs, products, customers, and other cost objects make on overhead resources. So we use a job cost sheet to calculate ending inventories and cost of goods sold. So let's look at that. Here is what we call a subsidiary ledger. It's all of a company's job cost sheets from jobs Alpha to Foxtrot. So here they all are. Okay. And now the balance sheet reporting, the job cost sheets provide the underlying set of financial records that explain what specific jobs comprise the amounts reported in work in process and finished goods inventories on the balance sheet. So here they all are. Now, on the income statement, the job cost sheet provides the underlying set of financial records that explain what specific jobs comprise the amounts reported in the cost of goods sold on the income statement. And so here are those subsidiary ledgers for the cost of goods sold. Okay, now, an external reporting perspective, the amount of overhead applied to all jobs during a period will differ from the actual amount of overhead costs incurred during the period. Number one, when a company applies less overhead to production than it actually incurs, it creates what is known as under-applied overhead. And when it applies more overhead to production than it actually incurs, it results in over-applied overhead. So, the cost of goods sold reported on a company's income statement must be adjusted to reflect the under or over applied overhead. So if it's under applied, we need to increase cost of goods sold. And that, of course, will decrease your operating income. And just the opposite, if we've over applied overhead, we've applied too much cost to our jobs, we'll decrease cost of goods sold and increase our net operating income. That looks like a good place for us to stop this video. And when we return, we'll take a look at using job order costing in service companies. Until that time, bye for now.